If you're an investor, you've probably heard of Texas Instruments. But lately, if you've been looking at their numbers, you might be asking yourself one simple question. What on earth are they doing? Well, today we're going to unpack their massive and, frankly, pretty counterintuitive bet that's really shaking up the semiconductor industry.
And that really is the central question of this whole explainer. Why would a hugely successful, profitable company intentionally tank its own short-term profits? I mean, it seems crazy, right? But to understand the logic, you have to start with the one thing, the one principle that drives every single decision they make. You see, to really get what Texas Instruments, or TIXN, is all about, you have to know that they are guided by a single, all-consuming goal. Every single decision, every dollar they spend, it all serves this one core purpose. And that purpose is to maximize the long-term growth of free cash flow per share. Now, if you're not familiar, just think of free cash flow as the actual cash a company has left over after paying for everything it needs to run and grow its business. It's kind of the ultimate measure of profitability, and for these guys, it's the only metric that really truly matters. It's their North Star. So, okay, how are they going to generate all that cash? Well, they rely on a business model that's built on 4 key competitive advantages. You can think of this as the engine that powers their entire strategy. These advantages are their super advanced manufacturing, a gigantic portfolio of over 80,000 products, the fact that they sell directly to their customers, and their focus on really long-lasting markets like industrial and automotive. They all kind of work together, they reinforce each other. But that first one, manufacturing and technology, that one is the absolute cornerstone of everything. Okay, so let's dig into that manufacturing advantage. The key number you really need to wrap your head around is 40%. That is the incredible cost advantage Texas Instruments gets by producing a chip on a larger 300mm wafer. And look, this 40% isn't just some small improvement. It is a massive structural advantage. Most of their competitors are still using the older, smaller 200mm wafers. Think of it like making pizzas. A bigger pizza is going to give you way more slices for a similar amount of work. By moving to 300mm, TXN can just crank out more chips, way more efficiently, giving them this cost advantage that is incredibly difficult for anyone else to beat. Now, this cost advantage gets even better when you look at where they're building. I mean, in today's world, a secure, reliable supply chain is everything. So by building these advanced factories, or fabs as they're called, right here in the United States, TXN can offer its customers something absolutely invaluable: geopolitical stability. That reliability has become a huge selling point. So to make this manufacturing moat even wider and deeper, the company is making a truly massive bet. They are smack in the middle of a huge, multi-year investment cycle that is completely unlike anything they've ever done before. We are talking about $5 billion a year. That is the insane level of spending they're committing to build out their U.S. manufacturing footprint. And this is a totally counter-cyclical investment. While other companies are pulling back during a downturn, TXN is absolutely flooring the accelerator. But a bet this big, well, it comes with a cost, a very big one. And this is where we get right back to our original question. This massive spending is a direct and completely intentional hit to the company's short-term financial performance. And you can see the impact right here in the numbers. I mean, just look at their most important metric, free cash flow. Back in 2021, they generated over $6.3 billion in cash. By 2024, that number is projected to fall all the way down to just $1.5 billion. They've basically wiped out nearly 75% of their cash generation on purpose. And it's the exact same story with return on invested capital. That's a metric that just shows how well a company is using its money to make profits. It has plummeted from a stellar 42% to under 16%. Now, from the outside, these numbers look genuinely alarming. But you have to remember, this isn't the sign of a failing business. It's the calculated cost of their long-term vision. So this gets us to the crucial point for any investor. You have to weigh the potential reward of this strategy against its very real risks. Is the future payoff really worth all this current pain? You've got two sides of the coin here. The potential payoff is decades of market dominance. But the risk? Well, it's a high-stakes gamble with absolutely no guarantee of success. So let's break down the bull and the bear case. So if all of this works, the bull case is incredibly compelling. TXN comes out of this investment cycle with an even bigger cost advantage, which leads to fantastic profit margins. They'll be able to just snatch up market share while their competitors are scrambling for capacity. And management's even put a number on it. They're targeting $8 to $9 in free cash flow per share by 2026.
But the risks are just as real. Building these giant fabs is unbelievably complex. Any delays or cost overruns could cripple the whole plan. If there's a deep industry downturn, it could really strain their finances. And competitors like Infineon, they aren't just standing still. And, despite this big U.S. focus, about 20% of their revenue still comes from China, which is a significant geopolitical risk. So this brings everything together into the core dilemma that's facing anyone looking at Texas Instruments stock today. Ultimately, the entire analysis really boils down to an investor's time horizon and their conviction in management. In other words, it all comes down to two questions. How long are you actually willing to wait for this to pay off? And how much do you really trust this team to pull it off? And so we end up right back where we started. Texas Instruments is sacrificing today's profits for a shot at tomorrow's dominance. The question for any investor is a simple one, but the answer is anything but. Is that a trade you're willing to make?